How you doing? I'm Big D. Thanks for stopping in and spending a few minutes of your day with me. What we're going to talk about today is something that is possibly going to push silver and gold to its new levels that we've never seen before. Now, this new document, I don't have the whole document, but I'm reading through some different things that one of my YouTube subscribers had sent me. And it's a government document that well, I'm going to explain it. So please stick around. Now, none of this has hit any mainstream media. So believe what you like and maybe use what I'm giving you as maybe a direction to look into yourself if you want to research it. Definitely not on mainstream media, but it should have been at least on your morning news. It's been buried inside regulatory release, and it's a rule change that quietly reshapes the global banking system. And it's definitely going to treat gold and silver a little differently. Now, for the first time in more than half a century, and it takes effective immediately, not next year, not sometime whenever they decide, if all the banks want to comply. Now, this isn't theory, it isn't speculation, it isn't a trade idea either. It's a rule book change. The kind of banks don't get to ignore. Well, we're going to see if any of them start to ignore, like some of the bigger banks, and they'll take penalties instead of losing billions of dollars. Now, to understand why this even matters, we have to take a step back for a moment. At the top of the global financial hierarchy sits an institute most people never even heard about. It doesn't run ads, it doesn't give press conferences, it doesn't answer to voters, but every major central bank answers to it. The Bank of International Settlements. Think of it as the referee of global banking. When it rewrites the rules, banks around the world adjust, whether they like it or not. After the 2008, I believe it was, financial crisis, nearly brought the system down. Remember, too big to fail? Well, a lot of them failed. Regulators reached a blunt conclusion: banks were too leveraged, too fragile, and too dependent on the assets that disappeared when stress arrives. So they began rebuilding the rule book from the ground up. That process unfolds. It unfolded and slowly in stages over more than a decade. And now, with the final phase of the framework is complete. Here's the part that changed everything. Under new standards, globally, physical gold and silver, real metal, properly stored and fully owned, no longer treated like speculative commodities. Now remember, it is probably a very good idea. I'm not telling you to do this, but you should have insured your precious metals. Moving on. Now, no longer treating like speculative commodities, they are elevated. They now sit alongside cash and government bonds as top tier balance sheet assets. That's not a slogan, that's a regulatory classification. What does that mean in plain language? It means a bank that holds properly audited, fully allocated physical metal can use it to strengthen its core position. It improves their ratio. It reduces regulatory pressure. It makes the institution look safer on paper, which is exactly what regulators want. But there's a catch. Paper claims don't count. Unallocated metal doesn't count. Derivatives do not count. Only real physical metal and clear ownership stored in approved vaults, inspected and audited and uncontested. That single distinction is where the pressure builds. Because of decades, banks and financial institutions relied heavily on paper exposure to precious metals. Contracts, promises, synthetic instruments that require very little physical backing. Those structures working on long and metal stayed categorized as a single higher risk asset. Now it isn't. And that forces a decision. Either banks acquire real metal or they lose a capital advantage that they no longer afford and will be giving up. This isn't about investor sentiment. It isn't about geopolitical fear. It isn't about industrial demand forecasts. It's about compliance. When regulators change their strengthens of their balance sheets, banks respond not emotionally, but mechanically. And mechanics move markets. This shift also changes something else that rarely gets discussed: the economics of excessive paper exposure. When physical metal becomes capital efficient and paper exposure doesn't, the incentive flips. Structures that once made sense suddenly they do not. Positions that were cheap to maintain become expensive to justify. That's how long-standing distortions unwind, not through headlines, but through actual math. None of this guarantees price. No rule book ever does, but it does change the plumbing of the system. And when the plumbing changes, the flow changes in it. That's why this moment matters. Not because it's dramatic, not because it's loud, but because it's structural. These are the kinds of shifts that don't announce themselves, but years later, everyone points back to and says that this is the time when the turning point, and it started quietly in a document most people never even read. And that's what we're talking about today. It's from this point forward, if a bank has sold gold and silver, it doesn't actually own. If it's betting against metal, regulators now demand something in return: real capital, not a token buffer, not a rounding error, meaningful capital. The kind banks guard closely. And if they don't put the capital up, regulators they're going to do something about it, more or less. Now, dividend payments can be limited. Executive bonuses can be cut. Oversight tightens fast. That alone changes the calculation between short positions aren't free opinions. They now come with a carrying cost that eats directly into their shareholders' returns. Think about it. If, from the bank's point of view, if you tie up hundreds of millions of dollars in total quality capital just to keep a position open, capital that could otherwise be deployed into lending fees or low risk yield, that position has to earn its keep. And most short trades are precious and precious metals simply don't. They generate thin margins, sporadic gains, and long periods of dead money. Once the cost of capital is applied honestly, the math stops working. The rational move isn't clever, it's obvious. You unwind the short for free, you free the capital. You move on. That's not ideology. That's balance sheet logic. And this isn't hypothetical. Now, ahead of the rule change, we're already seeing positions quietly disappearing. Open interest has been shrinking, not because investors lost interest, but because institutions are stepping away from the exposure. They no longer want to carry under the framework. No speeches, no announcements, just exits. But here's the risk in waiting. When too many players try to leave the same door at the same time, prices don't rise. That's not speculation. That's mechanics, and this isn't driven by retail traders or momentum chasers. It's driven by compliance schedules, capital math. Banks aren't choosing timing. The calendar is choosing for them. Now there's a transition window. Regulators aren't demanding perfect overnight success with this new regulation. So they're not going to be having to comply right today, right? But it has started. But they are demanding progress. Banks must show that they're moving in the right direction steadily, measurably, and soon. Miss those milestones and scrutiny ramps up fast, which creates a second pressure point. Institutions now have a limited window to either convert exposure into properly backed physical holdings or reduce exposures entirely. Both paths require action, neither allowance complacency. And here's where reality intrudes. Physical metal doesn't appear on demand. The global supply of gold and silver are already spoken for. Mines, industrial users, long term contracts, mints, reserves. What actually trades freely is a thin slice of the total market. So when large institutions need size, real size, they don't get it quietly. They compete, and competition is a tight physical market. Doesn't resolve sideways. It resolves through price. This is why the next phase is about forecasts or opinions. It's about throughput. How much metal can realistically be sourced? How quickly and at what cost? When regulators deadlines collide with physical limits, something has to give. Now that's the real story here. Not panic, not hype, not a sudden awakening, just a rule change that rewrites incentives and forces action in the market that doesn't have much slack left. And once the process starts, and it doesn't need belief to continue, it runs on necessity. From this point forward, a bank can no longer be casual, short gold or silver. If they sold metal they don't physically own, regulators now require them to lock up real capital against that bet, not symbolic capital, not no counting tricks, actual top tier capital, and kind that belongs to shareholders. And if a bank refuses or drags its feet, regulators don't argue. They restrict the dividends. They cut off executive bonuses. They tighten supervision. That's the language banks understand. This single change breaks the economics of naked short selling. But why? Because shorting precious metals was never a high return business to begin with. It worked only because it was cheap to maintain. Once that changes, the trade collapses under its own weight. Think about the math from a boardroom perspective. If a bank has a large short position in silver, The new framework forces it to reserve a meaningful chunk of its best capital just to keep that position open. That capital isn't free, it's equity. It carries expectations. Shareholders want it to earn solid returns, not sitting idle, supporting a low margin trade. When you tie up hundreds of millions of dollars in a capital to chase a modest trading gain, the return on equity becomes embarrassing. Single digits, sometimes, well, sometimes worse. That's how careers end. So the response isn't ideology, it's practical. You close the short, you release the capital, you redeploy it somewhere that won't attract regulatory heat. And that process doesn't wait for headlines. It happens quietly before deadlines while price still looks manageable. That's why we're already seeing positions disappear. Exposure is shrinking, not because belief has changed, but because the rules have. But here's the trap many institutions face: they all see the same deadline, they all see the same math, and many of them wait hoping someone else moves first. That never ends well. When too many shorts try to exist at once, prices don't drift upwards. They jump. Liquidity vanishes. The exit narrows. That's what a short squeeze really is. No hype, no retail, no frenzy, but forced buying driven by structural necessity. And this one isn't optional. Banks don't get to sit it out. If they don't act, the penalties escalate automatically. Compliance isn't a suggestion, it's enforced on a schedule. Regulators did allow a transition window. Banks aren't required to be perfect overnight, but they are required to show progress quickly. Miss earning benchmarks and oversight tightenings, miss final deadlines, the consequences become very real, which creates a countdown. Institutions now have a limited number of weeks to either replace paper exposure with properly backed physical holdings or reduce exposure altogether. Both options require action. Neither allow delays. And this is where the physical market becomes the bottleneck. Gold and silver aren't software. You can't spin them up on demand. Supply is already allocated. Mines, industrial uses, long term contracts, reserves. What's actually available to buy in size is very limited. So when large institutions need real metal, they're not shopping. They're competing in a tight market. Doesn't resolve politely. That's the real tension here. Not opinions, not predictions, not sentiment. A regulatory clock is now ticking against a market that doesn't know how it's going to have the depth to absorb rush demand quietly. That's how pressure builds in the financial system. Slowly at first, then all at once. Under the new framework, banks don't get to sit in the middle anymore. Exposure that is backed by real metal has to change, has to change form or disappear. In practice, that means two things happen at once. Some positions get shut down entirely, others are converted into fully backed physical holdings. And I hope all banks do this. They should learn by JP Morgan Chase or JP Morgan's bank when they lost billions of dollars or hundreds of millions of dollars on their very last fine for shorting, for using the system, let's call it. And it squashed the silver prices for many years. Now, even if you assume only a portion gets converted, the amount of metal required is enormous by historical standards. And this is where the numbers stop being an abstract. The physical gold and silver market are not built to absorb sudden large institutional demand. Annual mining supply sounds big until you break it down. What is actually available at any given moment? After industrial use, long term contracts, existing obligations, those are met. Banks can't simply order metal the way they order software licenses. What's left over for discretionary buying is very limited, fragmented, slow moving. Used to be able to put in an order, 3 days out the door. Now it's probably about 10 to 20 weeks. That's my belief. They they throw it out there. It's between 8 and 10 weeks. I think it's much longer than that now. You have a mining of 800 million ounces per year of silver. Most of it's a byproduct. Then you have 500 million ounces minimum of demand. Solar panels, the new Samsung batteries. It's endless. The military need for silver. That is just silver. And you're trying to tell me that we can supply what's needed? I highly doubt it. This new regulation is going to push silver to heights. I mean, I just can't see it doing anything other than that. I am not a professional. I've only been thinking about how much I should have had and stacked over the years, and I get crazy about telling myself to get going, get doing this, do it, do it, do it, and I didn't do it. Now that I have a few ounces, I'm kicking myself for not getting more. So please take what I've just given you. Take the extreme amount of silver that's needed every year. Take the deficit that we don't have enough silver. We are in a deficit every year. At least a half a billion ounces of silver every year for several years now. And use that as, should I own silver? I think you should. I think not owning silver is a problem. But this is my idea. Like I said, take what I've just given you, along with some of my other shows that I've put out there, and you're seeing it going up. Every day it goes up and then down. It's very volatile, yes, but that's because of what I've talked about today. That is coming to an end. The volatility, I don't see it fluctuating like that in the future. Again, this is my opinion. I am not someone that's going to be able to give you 100% this is what's going to happen. But if you followed what's been going on with silver, if you follow about the industry alone of what is required, the deficits, the military need, the electric cars, the solar panels, it's ridiculous amounts of silver. China came out not long ago and says, we're no longer selling silver. We're going to keep most of it, especially to the West. And guess who the West is? That's us. I do appreciate you stopping in. Try to have a great rest of your day. Have a great weekend. God bless. And I do appreciate you.